So I get so many questions about taxes and how do taxes work when it comes to investing. So I wanted to go over that briefly today. So if you want to follow along, you can just Google Wealth Simple Tax Calculator. This is one of the best tax calculators that I found. It's extremely simple, easy to use. So I live in Alberta. I'm going to put in Alberta here. And for this example, we're going to use $61,000 employment income, which is the national average or one of the national averages. There's kind of, a lot of different opinions on it in different polls, but kind of a nice number that we're going to use here. So first of all, I want to call your attention to, if you make $61,000, you're paying almost $15,000 in taxes, which to me is just a mind-boggling number. It's about 24% of your income. And so most people just get their bi-weekly paycheck, deposit into their bank account. Okay, cool, this is my money I'm going to spend. But because this is shaved right off the top, you don't even see that you're actually paying this. A lot of people don't realize just how much money they're paying in taxes. And so if you were to pay nearly $15,000 every year to something, if you had to actually write a check or send a transfer for that amount, you would be like, okay, that's a lot of money that I'm paying to the government. What am I getting for it? And so that's kind of where, you'll see a lot of people have frustrations that it's very difficult or takes a long time to renew their passport, or government services that aren't delivered at a very high quality, or even with politicians on both sides, both parties, going on elaborate trips or spending a lot of money on furniture or paying crazy salaries to people. So, any of those government expenses are really coming out of your pocket and you're the one that's funding it. So that's why there's, a lot of scrutiny towards government spending. So this is, just kind of a high level overview. If somebody wanted to reduce their taxes that they're paying, one of the best and easiest ways they can do that is by contributing money to a registered retirement savings plan, an RRSP. So if we take our $61,000 here and we go and we times it by 0.18, 18% essentially, this is the RRSP contribution limit per year based on this salary. And so this is how much money somebody would be able to contribute. This is the maximum. If they haven't contributed in previous years, they would have unused contribution room on the table. The best way to find out exactly what your contribution room is to log into your CRA online account. And through that online account, you will be able to see the source of truth from CRA about what your contribution limits are. But just kind of use basic numbers. We're able to figure out, okay, for this year it's this. And so if we were able to contribute that much into an RSP account, we would be reducing our taxes by a little over $3,000. So this is what the new tax amount would be that you're paying. And of course, you don't see this as a solid number. This is all the deductions off all your paychecks. But if you were to put this money into RSPs for the year, you would likely get a refund of somewhere around this amount from the government. The best thing you can do with this money is then to invest it into your tax-free savings account or into a non-registered personal account. You want to invest this kind of extra money that you're getting rather than spend it. And then you can also see here that your average tax rate went down from 24% to under 19%. So that's a nice savings there. The money that you put into an RSP, you will have to pay taxes on eventually. So nothing in life is free. The saying goes true here. So we are, by putting this money in, we're kind of reducing our income. We're not paying tax on this money. However, in the future, and the goal is that you would take that money out when you retire. So right now, if you're living your life, you make $61,000. When you retire, you're likely going to have less expenses. So right now, whether you're single or married, have kids or don't have kids, life is a bit more expensive as a young, middle-aged adult. Traveling, like I said, if you have kid expenses, buying clothes, like car, all kinds of stuff. The idea is, though, that by the time that you're retired, your income, can be less because you're not going on as many trips, you're not spending money on kids, you're not buying as many clothes, you're not, so there's kind of that idea. And so in your retirement years, if you were to say take an income of like $40,000 or $50,000, depending on how much money you needed to live off of, um, your tax rate is also lower. So how we saw before, your tax rate was 24%. Now, as you're retired, your tax rate would be lower. And this is kind of multiplied if somebody's making a higher salary. Like, let's go with $90,000. They're paying that 26%, or even 120, 28%. So then in retirement, if someone making 120, then in retirement it's going to be making 60,000. They are paying quite a bit less in taxes. So that's kind of the idea with the retirement savings plan. You're saving money today by not paying taxes on it, so that you can invest it. And then the goal is that you would then take that money out of your RSP and pay taxes on it at a later time when your income tax percent is lower. The other thing too is that investments within your RRSP grow tax-free. And so that's really where the magic comes in. Because of course, if I was to say, okay, I'm going to put in, in this example that we had, if I was to put in my $10,980, but then if I was to take out this amount, when I retire, I mean, there are still tax savings, right? Because 24%, and then you'd be paying a lower tax later when you take that money out. But the real advantage is that this money then is growing tax-free year over year. And so, if you're young and you're investing for the next 10, 20, 30 years, 40 years, that money's able to grow tax-free. So that's where like a lot of savings come in. So that's kind of a quick overview of the RSP. Now, something else I want to talk a little bit about is people ask me, what are the taxes on a non-registered personal account? So actually, something else I'll quickly throw in here. If you invest money in a tax-free savings account, there are no taxes on that ever. So when I said things in life aren't free, that is kind of the one exception to the rule. Bit of the magical financial unicorn that we have in Canada is the tax-free savings account. Now, there are limits to that, how much you can put in. The best way to find out is just search TFSA limit. I particularly like the Globe and Mail calculator, but there's many calculators out there. And again, if you go into your CRA online account, that is the best way to find that information. So here you'll put what year you were born. So in my case, I was born in 1997. So I turned 18 in 2015. How much total have you contributed? If you've never put money into your TFSA, you can safely look at, okay, I have 57,000. But you have to be aware, think if you have a bank account, sometimes a bank will offer to open a TFSA for you. It's just like a cash account. So that applies. So you need to kind of make sure that you understand, any account that you have. But roughly you can say this is how much your contribution would be. And like I said, this changes for people based on when they were born. So the TFSA, let's see, it started, I believe, early 2000s, or was it in the 90s? Must have been in the 90s then. Or no, sorry, it actually started in the 2000s. This is because what year you turned 18. So, oh yeah, here we can figure out. So 2009 it must have started in there, around there. So someone who was born earlier than 1991, your limit for 2023 would be around 88,000, and then each year later than that, the amount would be smaller. So somebody born in 2004 would have a lower limit. So how it works is based on the year you turn 18, you start accumulating contribution room. Right now, the limit is $6,500. And so each year it's a different limit, and it kind of grows. So anyway, so that's for the tax-free savings account, which is the best, straightforward account. There are rules around, how much you can put in, when you're able to take it out. There's tax, or there's kind of fees if you put too much in. So there's rules that you need to understand about these kinds of accounts. But if this is maximized, and you've maxed out your contribution room, that's when you would kind of then fall over to a personal or a non-registered account. So what are the taxes on that? Well, people always say, what are the taxes that I'm going to be incurring on dividends in my personal non-registered account. And it's hard to say because it really depends on your other income. The number is totally customized based on the other sources of income that you have, if you're doing RSP contributions. So in this example, though, if so I'll show eligible dividends are dividends from public Canadian companies, and ineligible dividends would be dividends from private Canadian companies or international companies. And when I say public Canadian companies, I'm not talking about I'm not talking about Canadian traded ETFs that hold US companies. It needs to be truly Canadian companies. And so what I mean by that is if you have an ETF that like XIC, for example, that holds Canadian companies, those would be eligible dividends. If you hold a Canadian exchange traded fund like VFV, which trades on the Toronto Stock Exchange, that holds US companies. Those would be considered ineligible. So it's really important to understand what are the underlying companies to understand the dividend tax implications. But in a scenario where you were able to make, let's just say you were able to grow your investing portfolio and you were able to make $20,000 in dividends per year, which would be incredible, you'd pay next to no tax on those eligible dividends. If we were to make, $50,000, this calculator is slightly wrong because there would be some tax implications, and I think it's a little bit of a glitch that Wealthsimple has. But as soon as you add some other employment income, so let's just say we have, if we're taking out, let's say $20,000 per year from our RSP, that's going to count as employment income. So we can see here our taxes are $18,000, or sorry, our after-tax income is $18,000. We're paying a little under $2,000, so really nice low tax rate. And so that's kind of what I was referring to before about RSP. If you are putting that money in when you're retired, if you were to take out $20,000, I mean that's quite low. Let's just do $24,000. You'd have a little under $2,000 a month to live on. So not a whole lot per month. But as you can see, though, you're paying half the taxes percentage-wise than you would be if you were making $61,000. So then if you were able to grow your investment portfolio, so that $10,000 that we talked about, if you were to invest that and then you're getting, let's just say, $20,000 in dividends per year, as you can see here, the tax rate that you're paying on those dividends is quite low. And then with ineligible dividends, it is a little bit higher, but still relatively low. The taxes on dividends are significantly lower than employment income. Employment income is one of the most expensive taxed incomes. And that's kind of that phrase you hear, like the rich get richer. And one of the reasons for that is the way the tax system is set up. Really rich people don't work for a paycheck generally. They generally would have either properties that they're renting out, like, houses, or they have investments in the stock market, or they have a business that's making money, and they're likely paying themselves in dividends. Now, if they have a private company, it would be ineligible dividends, but they're still paying less tax on ineligible dividends than they would be on employment income. And so as you can see here, somebody who makes $100,000 from their paycheck is paying close to 27%, versus somebody who's making $100,000 in ineligible dividends, which would be if you had a private company and you paid yourself in dividends, which is a very standard practice, you're paying 16%. So significantly lower. And so the person who makes a $100,000 salary from their employer is paying a lot more tax than somebody who has a company and they're paying themselves $100,000 in dividends. So these taxes down here quite a bit lower. Capital gains as well, lower. So when people ask me about taxes in their personal non-registered investment account, they say, the one thing that I hear that I find funny is that if you're investing in your personal account, they say, oh, but I heard you have to pay taxes. Well, yeah. And they kind of view that as a bit of like, well, then I'm not going to invest in that account if I have to pay taxes. But what people don't realize is that you're paying taxes because you're making money. If I was to invest $50,000, I'm not paying $50,000 in taxes. I'm paying above and beyond what my investments make. So for example, if we just pull up a future value calculator, I like the calculator soup ones. If I was to invest $50,000 for 20 years and I'm earning 8% interest, or not interest, but 8% return, that $50,000 over 20 years, 8% would grow to this amount. It says interest here, but this is just kind of a general return. This is how much money you would be making. This is like, right, you put in 50,000, you'd have this at the end of it. This is the difference. This is how much you've actually made. Yes, you'll be paying tax on this amount, but you started with this amount. If you were to just put this as cash under your mattress or in a savings account and make $0, yes, you'd pay zero tax, but you'd only have $50,000. So you're paying tax on the difference here. And so in this scenario, if I was to invest $50,000 for 20 years, make 8%, and then I had this much left over, and I was to sell all of those stocks and just I wanted all the cash, I would pay 11.5% tax, $21,000, but I'd still be left over with this much money that is literally out of thin air. Again, remember, I'm only doing this amount. I'm not even talking about the base 50. The base 50 you keep. There's no taxes. You're only paying tax on what you make above and beyond. So hopefully this has been valuable. Play around with this calculator, but this is just really high level overview of kind of how the taxes work. There are a bunch of different fields here that you can enter into. I'll quickly explain the self-employed income. If you're an entrepreneur paying yourself as a self-employed person, there is a different income tax rate, but this is different than ineligible dividends. So if you're a sole proprietor and you pay yourself a bit of a salary, that would be considered slightly different than employee income, but paying yourself with dividends would be the best way to do it. The reason that people will pay self-employment income to themselves is because if somebody who only pays themselves in dividends was to go and apply for a mortgage, the bank could say, well, you kind of have a bit of like unstable income over the last few years because it's not consistent. Banks really like to see that employment income that's like very consistent paychecks over the years. And so if you're a business person that pays yourself a dividend every 6 months, $50,000 dividend every 6 months, that's where the bank doesn't, even though you're making a ton of money, the bank, in their, I guess I would say, antiquated financial calculations, it doesn't really, meet their threshold of like an ideal customer. So anyways, explore these. There are little info tabs. You can do research to understand all these more. This is an incredibly high level overview. But let me know in the comments what questions you have. Really passionate about investing and finance and love talking about this kind of stuff. I try to respond to every single comment that I get. You can follow me on TikTok at Wealth Canada, and then on YouTube as well, Wealth Canada. Thank you very much for watching.